Hey guys, welcome to another video. And this one I want to talk about warrants, specifically warrants as they relate to these SPAC companies. Warrants have been around forever, but they're getting a ton of attention now because of all the attention focused on SPACs. People are making a ton of money on SPACs, and there's actually an additional money-making opportunity on warrants. Warrants provide leverage, so you can actually use them to magnify the gains that you'd otherwise make in SPACs, and you can make some truly impressive gains if you actually know what you're doing with warrants. So in this video, I want to tell you what warrants are, how they work, some of the important dates, and the specifics of the structure of the contract and all that kind of thing. And if you stick around till the end of the video, I'll go into a very specific trading strategy that you can use with warrants to make some of these big gains, and how you can make some of the more the safer investments, the ones that will actually have a better chance of yielding those big gains. So let's get into it. Okay, so first off, let's look at what a warrant is. A warrant is basically a contract that you can buy, and this contract gives you the right to redeem it for common shares in the future. That's all it is. And basically, you can pay a price right now for this warrant. You can go out and buy it for $2, $3, $4, whatever it is. And then at some certain date in the future, it gives you the right to buy a share of common stock by paying an extra $11.50. Now, that specific will vary. Most SPACs will do it at a redemption price of $11.50, but you have to look at the specifics of the SPAC to make sure that's what it is. Whoever comes up with the deal can actually change it any way they want, but that's the very, very typical standard practice, is this $11.50 strike price. So that $11.50 is sort of a future payment that you're going to make for that stock, right? So the price you pay for the warrant now is basically a down payment. You're making a down payment on those shares at $2 or $3 or $4, and you're saying, yeah, I'll pay the extra $11.50 later on if I decide to buy it. But of course, the interesting thing about warrants is you don't have to redeem them for common stock. You can just trade them on their own merits, right? So I can buy a warrant today for $2, it goes up to $4, and I sell it, and boom, I've made a profit. There's nothing necessarily that I have to do with respect to redeeming it for common shares. So if we take a look at this diagram, this is basically comparing a warrant to a call option because they're very, very similar, right? But there's a few differences. So, a standard option, if you're familiar with a call, it basically is a very standardized contract. You buy it from the exchange, and it can either be a long or a short position. A short position is a put option. A long position is typically a call option. And those typically will control 100 shares of common stock, so a very, very standard ratio. A warrant, on the other hand, has a few differences, right? They're a custom contract, so you got to look very carefully at the specifics of that contract. Sometimes the fractional amounts are different, all kinds of things. So make sure you read what's called the S1 filing for the SPAC company when they go public. It'll have all the details in there. A warrant is long only. There's no such thing as a put version of a warrant. It's basically just equivalent to a call in that it's only long. And warrants are issued by the company only. There's no centralized exchange that is issuing warrants. There's no standardized contract. They're coming from the specifics of the deal, which again makes it super, super important to read that S1 and make sure you absolutely understand the characteristics of that warrant contract that you're buying. Now, the interesting thing about warrants is that in the early days of a SPAC company, they actually issue what are called units. And a unit is essentially a bundle, a little package that contains both a common share and a warrant. And typically it's a fraction of a warrant that's contained in this unit. So these units trade initially, right, when the company first goes IPO. And then 30 days after that IPO date, anybody that holds a unit has the option of unbundling the unit and splitting it up into common shares and warrants. And then at that point, you can do whatever you want with the unbundled components of the unit. You could sell your common shares and hold the warrants, vice versa, whatever you want to do. And the actual price of the individual common shares and warrants will start moving as they trade freely on the open market. Now, this actually was a trading strategy all by itself in the early days. You can still do it, but it's nowhere nearly as profitable. When SPACs were lesser known and lesser traded, they would issue these units. and they might issue them at, 12 bucks or something like that. You'd go ahead and buy these units, wait until the split date, you'd unbundle them, and almost immediately sometimes the individual value of the common shares plus the warrants would already be a little bit more than the actual value that you had paid for the unit. And so that in itself was a pretty good strategy, right? You could get in early, just wait for that date, split them open, sell them, and boom, money in your pocket. That doesn't really happen today, though. The big money has gotten wise to this and they've arbitraged away that particular unit splitting opportunity. But that said, it's still an absolutely valid way to go out and invest early in these SPACs. The thing you have to be really careful of here, though, is your particular broker and how they handle the splitting of a unit. I trade with interactive brokers, a lot of people do, and at IB, they will actually charge you $300 to conduct or execute a unit split, and it can actually take a significant period of time. And so that also sort of blows away this opportunity to buy units, unbundle them, and sell the separate components, because in the meantime, the price could have moved against you, and in fact, it probably will, not to mention the fees that you're going to pay to your broker to do this. Now, I understand other brokers will do this for free. If you're at one of those brokers, then maybe you still have an opportunity to do some of this. So I said in the intro that one of the key features of warrants is that they provide leverage, right? So you can actually use them to magnify the gains that you'd otherwise get in the common stock. So if we take a look at an example of this, like let's say you had $5,000 to invest and the common shares were trading around 11 bucks. So yeah, you could just go and buy 454 common shares for your $5,000. You could sit on that. Let's say the stock goes up to 20 bucks, right? So you've got a straight gain there from 11 to $20, really healthy gain. You've almost doubled your investment, and you've made basically an 81% return at that point. So that's great. However, you could have done a similar thing with warrants. You could have taken your $5,000. You could have bought 2,500 warrants at $2 each. Now, if the stock had done the same thing, if it had gone from $11 to $20, your warrant is now worth $8.50. So how do you get to $8.50? Well, you take the price of the stock minus $11.50, which is the standard strike price of your warrant, and that gives you that price of $8.50. So essentially, your warrant would have gone from $2 to $8.50, which is actually a 325% return compared to your 81.6 over on common shares. So it's that difference, that spread that is based on the strike price that actually creates that leverage effect and allows warrants to actually magnify your gains. Now, one thing I'll say about warrant pricing is that, at any point in time, you can go and look at the price of a warrant and the price of the common shares. And in theory, the price should be exactly $11.50, right? But it never is. It's always more than that. And people get endlessly confused by this and they say, well, this doesn't make any sense. What's going on? And really you need to understand two things about warrants. Number one is there's a risk premium that's built into the warrant. So common shares, if the deal doesn't go through, there's a floor of $10 because if a SPAC liquidates because it can't find a deal, everybody gets back $10 per share. So if you paid 12 and it liquidates, you get 10 back. So you've got that floor of risk underneath your common shares. Doesn't exist at all for warrants, right? So you're actually being compensated for holding those warrants for that additional risk, and that depresses the price of the warrant. So that contributes to spread. The other thing that contributes to that spread price is the fact that you can only redeem a warrant for common shares at some point in the future. So it's after the merger date, right? And so who knows what's going to happen to the share price between now and then. It could move all over the place. And so there's actually a significant amount of risk that it could even be below that strike price of $11.50, in which case your warrant is almost worthless at that point. So again, there's that additional risk from holding the warrant for that future price appreciation or depreciation that could happen. And so you're being compensated for that risk by paying less for that warrant. So it's all about that risk premium pushing the price of the warrants down. Now, that actually creates another trading opportunity because that risk is often overstated. And I'm going to get into this in the latter part of that in the video. But because of that overstatement of risk, if you're willing to take that risk on, you can actually make some money there as well. So first, though, let's talk a little bit more about redemption of those warrants. So I said, warrants can be redeemed for common stock at some point in the future. Typically, with your standard warrant, you have an expiry date of 5 years, which means that at any point within the next 5 years, you can actually use use your warrant for redemption. However, redemption is usually only enabled 30 days after a merger goes through. So, prior to a deal and prior to an actual merger being executed, you can't actually use your warrants to call in that common stock. But you can totally just trade warrants back and forth, buy and sell them as much as you like in the meantime. And you never actually have to wait for redemption, right? So warrants absolutely have their own value. You can buy and sell them anytime. There is one exception to this, though, and you need to be aware of it. So the companies that create these SPACs, they are very sensitive to the risk that could happen if the price of the common shares absolutely takes off, it skyrockets, and then there's a bunch of warrant holders out there that can go ahead and redeem for the strike price of $11.50. That would create a huge financial loss for these guys. It's a big liability. And so they put this redemption clause in that says if the common shares trade over $18 for 20 out of 30 trading days, that triggers the right on their part to force a redemption. So what they do is they will issue notice of forced redemption, and you actually then have to go in. I think you have like 30 days to do it, but you have to go into your broker and you have to redeem your warrants for common shares. If you don't do it before the deadline, then your warrants are worthless. They go down to a penny and boom, you're holding garbage. So you have to be really, really aware of this and pay attention. If there is a forced redemption, it's on you to go in and actually do that redemption at your broker. And unfortunately, for a broker like mine at Interactive Brokers, I'm actually going to be paying some stiff fees for that redemption. So, check your broker again and make sure you understand what those fees are. But of course, you can always just sell the warrants, right? If you don't want to actually go through the hassle of redemption, just go ahead and sell them and somebody else will do it. Okay, so now I want to talk about a specific strategy that you can use to actually trade warrants and actually get some of these really, really magnified gains using that leverage. So, like I said earlier, warrants are always pricing in the future, right? So they're always anticipating or forecasting the price of the common shares 30 days post-merger. So, the spread in price between the warrants that might be trading at, say, $4, like they are here in this graph, versus maybe the commons have shot all the way up to $30. The spread, the difference here between 30 and 4 is actually based on a risk premium price plus that lower forecast, right? So if we take a look at that, the theoretical spread here in this case, in this example that I cooked up, is $16.50. So today the warrants are trading at $4, the commons are trading at 30. So there's a theoretical drop being forecast in the common price of going all the way down to $16.50, right? Because the theoretical forecast is that $4 plus $11.50. And basically that's what that warrant is doing, right? It's saying, hey, this warrant can be redeemed for common shares at a price of $11.50 into the future. Well, if you paid $4 for it today and you pay the other $11.50 later, that would suggest that the price of the common shares 30 days after merger is going to be $16.50, right? Now that's a theoretical forecast only. It has very little to do with reality, and this is where the trading opportunity comes in. See, I call this a theoretical future forecast because not all of it is a theoretical drop. Now, it's absolutely true that, the price of the common shares do tend to drop after the merger. And there's a lot of reasons for this. So PIPE investors will typically dilute the shares. They'll look for an early exit. That'll cause a price drop. Warrant holders, just like you and I that are investing in warrants, may redeem. That will force a dilution of shares because the company will have to issue new shares to satisfy the redemption to the warrant holders. And the other thing that can happen is real earnings will start to come out, or more details will come out on a company. And historically, these SPAC companies, once the real numbers have been made visible, there'll be some disappointment, I guess, on the part of investors, and you'll typically see a price drop. So it's very, very common to see a price decline into that 30-day post-merger timeframe. And so typically the price of your warrant is baking in that future expectation of a price drop. Now, the trading opportunity here, though, is that implied drop in price is almost always overstated, right? The market is over anticipating how much of a price drop can actually happen 30 days post-merger. The other thing is that in this example here, the difference between the two, the $30 and the $16.50 implied drop, is about $13.50. Now that $13.50 is made up of an implied drop. So yeah, the market is totally saying, hey, the common shares are likely to experience a drop. It's also made up of a risk premium because, again, the warrant holders are being paid to hold or take on that risk that the merger doesn't go through and their investment could drop to zero. So some of that 1350 is risk premium. And there's a little portion of it as well that I have in purple here in this diagram that's a difference in demand. So one of the opportunities with warrants today is that not everybody can trade warrants, right? Some of the big brokerages don't allow people to trade warrants. It's considered a bit of an exotic derivative, I guess, and you have to get special permission in many trading accounts to be able to trade warrants. There are some tax sheltered account types that don't allow you to trade warrants. So all of these restrictions on warrants mean that the supply and the demand, so the pool of buyers and sellers for warrants is smaller. And so it's a little bit more difficult for the price of a warrant to accurately track the price of the underlying stock, which anybody with any brokerage can go ahead and buy, sell or trade those common shares. So that difference in demand, the risk premium, and the implied drop all contribute to this spread, which is the difference in price between the warrants and the common shares. Now, I said that this implied drop is overstated, and we know this is true because of what's called implied volatility. So any options trader out there knows that implied volatility is always overstated by just a little bit. And the same mechanism, or a very, very similar mechanism, is at work here in terms of the implied drop that's baked into the spread price here. It's basically the same effect that you see in options trading. So if we're willing to take on this risk that the implied drop will not be as bad as it's forecast, if we're willing to take on the risk premium by holding these warrants, and if we can actually take advantage of the small inefficiency because of the different supply and demand situation that's here in warrants, we can sometimes score a really, really good deal on these warrants, right? And the bigger the spread that we can actually see, that the larger price difference between the warrants and the common shares, the greater the opportunity is that we can actually see some gains. And remember, whatever gain we see is going to be magnified by leverage, right? Now, of course, you have to find the right companies to execute this type of opportunity, right? So the best candidate companies for this sort of trade are the really, really A-plus solid companies, the ones that have a really, really good business model. They're considered top shelf, like your first round draft picks amongst your private companies that these SPACs are going after. You want the companies that every SPAC was trying to get, and then the SPAC that wins it, that's going to be an awesome business, chances are, go forward, because the competition was so high. So that right there makes it a really, really good choice. The other thing that makes it really good is you want a lot of excitement or hype behind the company. And the reason is that's going to push the common share price higher in the short term. Remember, we're looking for a big spread between the price of the commons and the price of the warrants. And that is way more likely for a company that has a ton of hype driving retail investors into those common shares and causing that escalation in the price. And the more hype, the more excitement that is driving those commons, the better they're actually going to hold their value through post-merger, because that excitement, that hype will still be there, and maybe those investors will hang in there just a little bit longer and hold up the price of the common shares. And the longer it holds up and the higher it holds up, the better for the warrant holders that are taking advantage of that spread differential. Now, the thing is here, though, you can't chase the overvalued deals, right? So the trick to this particular strategy is to get in as early as you possibly can, right? So, I think that the best time to do it is when a SPAC has identified a good target. If you think there's a good chance that the team can execute on that deal, then it's a really, really good time to buy those warrants, right? Because as that deal starts firming up, interest is going to be attracted to the SPAC. That's going to start driving up the price of the commons. And if you can get the warrants at a good deal, then that's the time to do it. So, you really want to look for that wide spread, right? So take a look at the price of the warrants versus the price of the commons, and the larger the difference, the better the opportunity, right? So look for those common shares that have had a huge run up, but maybe the run up in the price of the warrants hasn't been as great. That's one to absolutely look at. Now, that said, don't chase, because if the price of the warrants is heading up into that, $3 or $4 range, then the opportunity is probably already gone, right? And what you may need to do is wait for a pullback if it's a really, really good company and a really, really good deal, or just start looking at another one where the spread is larger and the opportunity is a little bit greater. So, if the commons are over 15 bucks and if the warrants are over 4, it's probably too rich at this point. But if you can get in underneath those numbers, then it could be a really good opportunity. So guys, that's it. That's the story. Hope this is helpful. Please throw the video a like if it is. Don't forget to subscribe, ring the bell, and I'll see you on the next one.